What's up everybody, Crypto Noah back with another video, and in this video I'm going to show you with some of my real pools, real math, real everything, how you can generate $1,000 per day yield farming on decentralized exchanges such as Uniswap v3 using their concentrated liquidity feature. And before we even get into it, I do have to say none of this is financial advice. These are just my opinions. This is just what I'm doing. Do your own research. Use this channel as a starting point. So in this video, like I said, I'm going to show you how I'm making $1,000 a day and how you can do the math so you can apply that to your pools. We're going to briefly cover what yield farming is, because I'm sure there's a lot of newbies watching this video who don't even know what it is, maybe never heard of it. And then at the end, if you stick around, I'm going to tell you if you should be trying to make $1,000 per day and how you should look at going about setting your pools and how yield farming fits into your overall portfolio. So without further ado, let's jump right into it, guys. So what is yield farming? Yield farming is the act of getting a yield in the decentralized finance space. There are four ways. The first way is staking, single-side staking. You can go on the Ethereum beacon chain. Ever since they moved to ETH 2.0, you can stake your ETH to help secure the network, and you can get a yield, probably like 13 to 14%, no big deal, but your funds are locked up for a certain amount of time. The second way is through using your funds to facilitate borrowing and lending. So you can go on a platform like Aave or Compound. You can supply your assets, stable coins, Ethereum, Bitcoin, whatever they allow on the platform. And then they allow borrowers to come and borrow it. And that's where your yield comes from. You're getting paid to facilitate lending. The third way is staking your funds on a platform such as Nexus Mutual to help facilitate insurance premiums, right? And the fourth way, the most profitable way, my favorite way, the way we talk about on this channel, I feel like I need some music when I was saying all that, is staking your funds in the form of pairs on decentralized exchanges such as Uniswap, such as Trader Joe, such as Osmosis, all of these exchanges I've made videos on. And what you do is you stake your funds in a pool. For example, let's say it's ETH USDC. If you're in the ETH USDC pool and people are trading back and forth from ETH to USDC or USDC to ETH, whatever your percentage in the pool is, that is the percentage of the trading fees you make anytime there's a swap. So for example, let's say for easy math's sake, it's $100,000 in a pool. You deposit 5K in ETH, 5K in USDC. Your liquidity makes up 10% of the overall liquidity in the pool, which means you get 10% of the trading fees. And the cool thing about providing liquidity on decentralized exchanges is there's something that Uniswap brought to the Web3 world. And I say Web3 world because it's just like traditional market making. And I made a video on the difference between yield farming and market making and why yield farming is better. Watch that if you haven't. But basically, you get to pick the price range where you want to provide your liquidity in. So going back to the ETH USDC example, let's say you think ETH is going to trade between the price of 2,000 to 3,000. You can provide your liquidity within that range so that whenever the price is in between $2,000 and $3,000, you're making passive income, like I said, in proportion to what your liquidity makes up in the entire pool. So now that you know what yield farming is and kind of what you have to do, you're probably wondering like, well, how do I make $1,000 a day and how do I know which pool to get into? Because I'm sure it's numerous ones. Well, that is a good question. So I made a video on how you determine which tokens to yield farm and when. Definitely watch that if you haven't. But basically, when you go about picking your pools, the first thing is you don't want to provide liquidity for any two pairs, any two tokens that you don't mind holding on your own. So if you're in ETHUSDC, you better make sure you don't mind holding ETH if it goes out of range, or you better not mind holding USDC if it goes out of range. And what I mean by going out of range is it's this thing called impermanent loss. So going back to the $2,000 to $3,000 example, if the price exceeds $3,000, well, now you're going to be in 100% USDC, right? If it goes out of range to the downside, you're going to be in 100% ETH. This is called impermanent loss. And a lot of people say, oh, impermanent loss is bad, da da da. I made a video on how you can make impermanent loss your best friend. And most of the strategies I do, the success of them depends on how much impermanent loss you can get. And I found this the best way to win in yield farming, as I've been doing it for almost 3 years now. So after you find your tokens that you don't mind providing liquidity for, you want to find pools within those tokens that has high volume to TVL ratios. I'll show you an example with one of my live pools. So we're going to go over to Uniswap. You're going to hit pools. We're going to hit top pools. And we're going to be covering a pool I've covered on this channel a lot lately, my Maple ETH pool. So you type in MPL and you see Maple ETH. So right now the TVL is $268,000, but the volume is $145,000. So it's almost close to the TVL, right? So the more the volume is closer to the TVL, or if it's over, even better, the more money you make. So like you wouldn't make as much money in this pool because the volume, the 24-hour volume, is only 33,000 and the TVL is 225K. This is a drop in the bucket compared to this. And I'm just going off the 24-hour volume right now. Like you can click it and you can look at the all-time volume. And as you can see, volume's been starting to increase as people are kind of waking up to Maple. And I expect that trend to continue. An even better thing you want to look for is projects with low TVLs but favorable volume to TVL ratios. What I mean by that is right now Maple is a undervalued gem. We made a video doing a deep dive on Maple where we went through the tokenomics, the team, the value proposition, literally everything you need to know. And then I made a price prediction video to show you how you can turn $15K into $1 million. And I showed my yield farming strategy in that video. Definitely give both of those a watch. But the TVL is extremely low. But once people wake up to this and the bull market starts to ensue and people go to start buying it, you're going to have people buying a lot of this from this particular pool with their ETH because the TVL in the USDC pool is lower. So that means the slippage is going to be higher. So as a trader, slippage sucks, but as a liquidity provider, slippage helps you because that fee goes to you. So if you can find a pool where the TVL is low, but the volume is high, what's going to happen is once the bull market comes, the TVL is going to increase, but people are going to be buying faster than liquidity providers are going to be providing liquidity. So that means the few people that are in this pool, they're going to be able to make a lot more money. It's almost like having a monopoly on the pool. Like only a few people are going to get paid until more people get in, obviously. All right, so just to show you guys an example on what I mean for the slippage, I only have 0.1 ETH in this particular wallet right now. But even if I were trying to buy that small amount, it's a negative 1.03% slippage rate. So you can imagine how much higher it'll be. Like if I try to buy 5 ETH worth or 10 ETH worth, the more I go up, the higher the slippage, which means the more fees that I get from being in the pool. Okay, so here we are on Revert Finance, which shows your pool positions. You just connect your wallet. So I have 2 Maple ETH pools on this particular wallet. On this one, I'm getting 138% APR. As you can see, I've been in this one for just 19 days, so a little over 2 weeks. And I've already made $773 from doing absolutely nothing, right? If you go here, you can see my ranges. So that first range is from this line, the top line, all the way to the bottom line. And if it goes out of range to the downside, I'm happy with that. Because like I said, the more impermanent loss, the better. If it goes out of range to the downside, I'm going to be in 100% Maple. I'll exit the pool temporarily. I'll enter into another one. Depending on what the market's doing will determine my range. But I'll leave some of that Maple that I accumulated, probably like 30% worth. Just hold it, wait till it goes back up, take some profit, and use some more to get into a pool. And this way, I'm actually profiting. If I go back here, it gives you all the data and everything else. Now, if I go down here to this pool, this is a tighter range. Right now, I'm getting 1,875%. Now, guys, full transparency, I've only been in this pool for about 3 hours. So this has to catch up. I've already almost made back my gas fees. Spent like 60 or 70 bucks on gas. In 3 hours, I've already made 44 bucks. And I imagine that once this starts to balance out, I'm probably going to be at around 1,000% APR for doing absolutely nothing. Just going back on here, that range is from this top blue line all the way to this bottom blue line here. So just a small range here. So both of my positions are within range. And for the small one, I like to follow it. Wherever the price of Maple ETH goes on this chart, I'm going to be a couple of percentage points, probably 10% above price, 10% below price, and just keep doing that. Now you're probably thinking why would you just keep rebalancing? Won't impermanent loss hurt you? Well guys, like I've said on many videos, I reserve a certain section of my portfolio strictly for yield farming. So that doesn't mean if it goes out of impermanent loss to the upside or the downside, I'm already in house money with what I'm yield farming with because of how I've been doing it. And guys, this is a biblical concept as well. Whether you believe in the Bible or not, the principles hold true. If you go back to Genesis, Abraham was the first person God said was rich. He actually said he was very rich, and he said what he was rich in. And I made a video on this talking about yield farming's biblical principles, so give it a watch. But basically, he was rich in silver, gold, and livestock. Silver back in the day served as a medium of exchange. It was used for small purchases, so that's cash. And this is Abraham's investment portfolio. Gold was used as an asset. People speculated on it. It was used for larger purchases. This is the security or asset portion of your portfolio. And then the livestock was cash flow. So you can take your goats, take your cows, you can sell the goat milk, you can sell the cow milk, you can have your sheep and you're cutting the wool off and you're selling the wool and you're getting paid in silver and gold so that you can accumulate more silver and gold to add to your portfolio so you can then take the silver and gold and buy more livestock. And you're mixing and matching it. You're mixing it together versus just one of them. God didn't just make him rich in gold and silver, nor did he just make him rich in livestock. He made him rich in all three because my estimate or guess is this is a well-balanced portfolio and they can feed off of each other. Like there are certain seasons where crops aren't yielding, so you have to rely more on the gold and vice versa. It's the same thing with your yield farming portfolio. Okay, so now let's do some math. How much do you need in order to make $1,000 a day? Not factoring in compound. I'm just saying you're claiming your rewards and send them somewhere else. I don't compound my rewards, and I'm going to make a video on if you should compound your rewards or not. So look out for that this week. It'll be releasing in a couple days or so. But I'm going to do the math just for these pools that I'm in. I am in multiple pools across different wallets. And when you guys are doing the math, you'll have to factor in how much you have in each pool and do the math for the total. But I'm just going to give you guys the formula, and I'm going to do it for these two pools here. So if I'm getting 136% APR, you want to divide 136 by 365, so that's 0.36% per day. So how much principal do you need to have in order for 0.36% to equal $1,000 per day? You would need $279,000 as your principal in order to make $1,000 per day, getting 136% APR. However, for this pool, let's just say you're getting 1,000% APR because that's probably what it'll round out to, 1,000, maybe 1,200, and that's because it's a good volume to TVL ratio, and the TVL is low and the slippage is high. You would need to do 1,000 divided by 365, and that will come out to 2.73%. So then you need to do the math on what does your principal have to be in order for you to generate $1,000 per day at 2.73%. And the answer to that is $36,700. But now that we've covered this, let's talk about if you should even be trying to make $1,000 per day and if that's the right mindset you need to have in order to be a successful yield farmer. Okay, so to answer the question, should you aim to make $1,000 per day? The answer is it kind of depends. If you have like a super small amount and you're just looking for high yields, you will lose most likely because you're probably going to provide liquidity within a tight range, not know how to manage it. I don't recommend people yield farm to just pay their bills because yield farm is not the end all be all. It works best when you're mixing it with trading, in my experience. What I recommend you do is do proper fundamental analysis so you can find good projects that you want to accumulate. Then you go about finding good liquidity pools with favorable volume to TVL ratios. And then you want to go about setting your ranges intelligently. Like, are you expecting the price to boom? Maybe give it more time on the upside. Are you anticipating the price to dip? So maybe you want to provide liquidity to the downside so you can get paid passive income to buy the dip. If you do these things correctly and you have a good range, your APY will be good no matter what because you took the right steps and because, to be quite honest, we're in the golden age of yield farming. And what I mean by that is, right now, and I've been saying this many times, yield farming is the best way to generate passive income in the history of mankind because for the first time ever, everyday people like you and I get to be market makers. Market making has been around since the 19th century, and it was only reserved for major banks, financial institutions, large hedge funds, etc., etc. A lot of red tape. Average people like you and I can't do it until now. And the cool thing is, these same banks and financial institutions aren't legally allowed to provide liquidity within the decentralized finance markets. So it's everyday people like you and I who are the only people who are able to do it. And to be quite honest with you, most of the people doing it are ignorant. They don't know what they're doing. And it's no fault of them. This is a new thing. We don't hear about market making in school. It's not a sexy topic. You know, there isn't a lot of content on it, so that's why I'm trying to make as much as I can to help people before these banks and institutions are granted the regulatory green light. Because once it is, then the yields are going to be saturated and this opportunity isn't going to be able to exist. Guys, one more thing that I forgot to add into the video. When you're yield farming and you're anticipating a bull market, not only is it good to give your ranges room to the upside to run so you can, get paid passive income and take profits, but when you're looking at pools, if you're trying to be active in the pools as the market is going up, it's good to look at volatile pairs. And what I mean by that is not a stable coin mixed with a stable coin or a stable coin mixed with an altcoin, like two altcoins, because a rising tide raises all ships. So in the bull market, obviously one of the altcoins are going to outperform the other because nothing's going to move exactly the same unless you get lucky. But when that's happening, like, and you have your range and both of the assets are going up, picture these are both the assets. One may be going up more than the other, but they'll both still be within your range or have a better likelihood to be within your range. So only time I'll pair an altcoin with a stable coin is if I'm using that pool to specifically take profits at a certain level, or if I think it's going to consolidate within that range for a specific time. But if I'm trying to be active in the bull markets, yield farming, which I am with some of my capital, I'm looking at volatile pools only. Hope that helps. So guys, if you like this kind of content and that sounds like something you're interested in and you want to accumulate assets and grow your portfolio and manage it like institutions. Remember, institutions beat retail all the time and they're managing more capital, which makes it harder for them to get in and out of positions. So our Know It All Academy covers everything you need to know with mindset, how to think like a yield farmer, how to think like an investor. And then we have our intro and advanced yield farming section. It covers literally any strategy that you can deploy, the same strategies that professional market makers have been doing since the 19th century. Not so that you can deploy all of them, but so that you can find one that is in alignment with your goals, your personality, and risk tolerance. So ultimately, you can make more money and have a chance at accumulating generational wealth in crypto, because we're in the midst of the largest transfer of wealth in human history. The Great Wealth Transfer says that over the next 8 to 10 years, millennials are set to inherit $64 trillion from their parents and grandparents. Most of that money is going to find its way into crypto. So investing into this asset class is like investing into the stock market, into the S&P before the roaring 20s, guys. Like, when has there been a time when you can invest into a brand new asset class going mainstream as institutions are getting in? Like, this type of opportunity won't come around again in our lifetime. I guarantee it. So if you're looking for an elite group, click the link in the description or visit knowitals.xyz, book a free strategy session. Ultimately, we'll see if this program is a good fit for you. We only let a certain amount of people in. We're looking for members who are self-motivated, who are serious about investing, who are passionate or at least interested in crypto, just so that we can feed off of each other and bring different opportunities to each other so we can all make money together and have a good time. So if that sounds like you, we love to hear from you. But guys, with that, I'd like to conclude this video. I hope you got value from it. If you did, I ask that you consider subscribing, drop a like, drop a comment. Let me know what you want me to cover next, what yield farming strategy, what yield farming modality, whatever the case is. I'm here to bring value to you guys. So with that, I thank you guys so much for tuning in. I love every single one of you, and I'll see you guys in the next video. Take care and trade safe.